Hi, I'm William Dolan, and this is Esquire Advice, where we explain complicated and lucrative real estate and business topics. Remember, we are not forming a lawyer-client relationship by way of this channel. Always consult your local attorney before taking any action. With that said, grab a pencil and a piece of paper and get ready to learn. Welcome to our episode on the use of holding companies in real estate investing transactions. Before we get started, please kindly hit those like and subscribe buttons so we can keep bringing you valuable and profitable content. By way of preview, this episode is not about why you should own your properties in an LLC, which is another great topic that we've covered. Instead, this video is about the use of holding companies for real estate investing transactions. First, let's define holding companies. Holding companies are entities, which in the real estate world should be LLCs, that are formed to own interest in one or more other entities. Another way to think about it is that the holding companies own passive assets and not operating business assets because they sit a level above the operating entity. If it seems a little confusing, don't get discouraged. I think it'll be clear when we go into some of the diagrams in a moment. So why do I say an LLC in the real estate world? And more importantly, didn't I just say that this video was not going to talk about why you should own your properties in an LLC? Well, what I meant was a few moments ago, we're not going to talk about the type of entity you should use to directly own the property. However, we need to talk about the type of entity that the holding company will be. I mean, after all, that's the subject of the video. So LLCs are the most flexible type of entities from a taxation and from a legal perspective as well. As for taxation, LLCs can be taxed as a partnership, S corporation, C corporation, or disregarded altogether for federal income tax purposes if it's a single member LLC. More on that part later. So LLCs are often referred to as a check-the-box entity because when you used to fill out the paper IRS forms, you would literally check any taxation box that you wanted, essentially, on the IRS form. So from a legal perspective, LLCs give you the most flexibility with respect to structuring rights and obligations of the parties, waiving fiduciary duties, and a myriad of other items. Also, I always recommend Delaware LLCs. Please see our episode on why Delaware LLCs for more information on this point. And yes, I do practice law in Delaware and form lots of Delaware LLCs. I also used to work at a big law firm in Delaware and have had many firsthand insights into why Delaware entities are the top choice. So now that we know that holding companies should be Delaware LLCs, let's talk about why holding companies are used in real estate transactions in the first place, or at least the primary reasons that might be applicable to you guys watching. So it's worth noting that holding companies are not always useful, and sometimes they can overcomplicate things. So we're going to look at the two primary reasons why holding companies are used, or again, at least the ones that will be most applicable to those of you watching. So the first is to expand financing options, and the second is for income tax reporting efficiency. So as for financing, let's take a look at a non-holding company structure first. Here, over here to my left, your right, there are two people who own 7 properties, and each is owned in a separate LLC, which is the ideal way you'd want to own these properties. When you want a loan, your lender will require that, in this example, RELLC1 be the borrower, and RELLC1 will have to grant a mortgage to the lender on property 1, among other things. Now, the same thing would hold true for RELLC2 and it pledging property 2 and RELLC3 pledging property 3 and so on. So even if you have a mortgage loan on each of these properties, there still should be equity in them. With you paying down principal each month when you're making your mortgage payments and with the value of the properties appreciating over time, that equity will grow, but there's not going to be a good way for you to tap into most of that equity, because many lenders will not do second mortgages on investment real estate, and the ones that will limit the loan to value ratios so much that it generally isn't worth it. Now, let's take a look at a diagram showing a holding company structure. Here, there are 9 property owning LLCs, and each of those own a property, and all 9 of the property owning LLCs are owned by a holding company. In this case, it's labeled as RE Holdings LLC. The idea is that RE Holdings LLC can tap into its indirect equity in these properties. This generally doesn't work well with residential properties unless you own at least 50 in this structure, maybe more likely 100 or more. But to illustrate the point, I'll walk you through an example anyway. So let's say each of these 9 properties is worth $1 million and you have a $700,000 mortgage loan on each one. That means there's $2.7 million in equity tied up in these properties. You have $300,000 of equity in each property and there's 9 of them, so that's how we get to $2.7 million of equity. So a mezzanine lender might agree to lend $1 million to $1.5 million against that $2.7 million in equity. Again, I think this transaction is probably a little too small in scale for a mezzanine lender, but you get the idea. So if you accumulate a lot of properties or you get into commercial real estate, this concept has more value. So as far as income tax reporting, this one is a little more straightforward and benefits everyone where there's more than one owner to the LLCs. So first, let's look at the non-holding company structure depicted on this diagram. There are 2 members of these 7 LLCs, which each own a separate property. In this situation, the IRS will treat each of the 7 LLCs as a partnership, and each LLC will have to file a partnership tax return. So you can see how quickly this would add up. There are some accountants that charge $750 per business tax return, but most of the good ones that I know charge $1,000 to $2,000 for these. So here you're looking at $7,000 to $14,000 in income tax preparation costs. Now let's look at a 2-person ownership structure with a holding company. Here you will see that the 2 members directly own the holding company only, which is again labeled RE Holdings LLC. Then RE Holdings LLC is the single owner of each of the 9 property owning LLCs. So do you remember a few minutes ago I mentioned that a single member LLC can be disregarded for income tax purposes? That means that each of these 9 property owning LLCs can report for federal income tax purposes at the holding company level. So instead of having 9 separate partnership tax returns, there would only be 1 partnership tax return. So even if your accountant charged you $3,000 for that tax return, that would still save you $6,000 to $15,000 each year on income tax preparation. That is a lot of savings, and the more properties you own in this structure, the more you will save. An important note here, you still need to make sure that you're accounting for these properties separately, or these property owning LLCs separately. You need to treat them like they're separate entities in every other way other than for income tax reporting purposes. This is to maintain your state law limitation of liability protections between the different LLCs, which is why you formed the LLCs in the first place. All right, so for those of you that are still awake, the 2 primary reasons that holding companies are used on real estate transactions are to expand financing options and to save money on income tax preparation costs. If you're interested in more real estate and business topics, we have episodes on many other topics, so check them out. Again, kindly hit the like and subscribe button so we can continue to give you more great content, and hit the notification bell for YouTube to let you know when we've released a new episode. Thanks for watching, and I'll see you next time.